My name is Thibaut. I lived in Burundi and South Africa before moving to Luxembourg.
I'm Morgana. I'm from Dallas, Texas, and I moved to Luxembourg a few years ago.
My name is Nicholas, originally from Switzerland. I moved to Luxembourg 2 years ago.
I'm Diana. I moved 3 years ago from Lisbon, and so far it's been quite a ride.
I think Luxembourg is a very good place to develop your financial career because you have all the global big players here.
We get exposure to high-profile clients that you probably would not have the chance to meet if it wasn't for being here.
Moving to Luxembourg was easy. There are a lot of expats, so you'll easily become friends with your work colleagues.
In summer, the city is crowded, the parks are full, there are a lot of festivals, a lot of different people. It's very international and this is pretty exciting.
What I love about living in Luxembourg is how nearly anything you want to do you can find. I like to write, and I found this great literary cafe where I can meet with other writers and get their feedback, and we can discuss each other's work. I like to visit art galleries, and there's always some kind of exhibition going on as well.
Growing up around the world gave me a sense of responsibility and a need to act. And this is why working in sustainable finance here enables me to tie in my personal ethos with my career aspirations.
People keep pushing the boundaries of what's possible, making sure that Luxembourg keeps its position as a market leader.
Networking is very important here. I was part of an event for women in finance, and I got to meet a lot of my peers, which is also very nice to meet other women in the industry.
One of my personal favorites here in Luxembourg is the ability to just take my bike after work, ride into the sunset and clear my mind. It helps me to disconnect after a long day.
For me, important in a job is to be part of a team, not just a single player. And this is also what I really like about basketball. You need to rely on each other, hold each other's back.
When I'm not at work, my favorite thing to do is to ride my motorcycle through the countryside. It helps me to escape a bit the routine of office work and gives you a sense of freedom.
I think people are really looking for jobs that give them a sense of purpose and a sense of fulfillment, but also allow them to have their own personal lives, and this is something you can definitely find here.
Welcome to the Sustainable Finance Forum, bringing together key sustainable finance experts from across the world to share their views on how finance can shape a sustainable future.
Ladies and gentlemen, good morning, good afternoon, good evening, wherever you are in the world. A warm welcome to the second day of the Sustainable Finance Forum 2022. My name is Judith Bogner, and again, it's my honor to lead you through the next 2 hours of this event on behalf of Luxembourg for Finance. Again, if you could do us a favor, if you comment anything on LinkedIn or on Twitter, please be sure to add the hashtag SFFL22 and the handle @LuxFinance so we can all see what you're commenting and share it around. And as yesterday, everything will be recorded and then made available on the website right here of Luxembourg for Finance. Now, allow me to warm us up with a few highlights and takeaways from yesterday. Luxembourg's Finance Minister Yuriko said that the strong focus on E as in climate finance, the E in ESG since COP21 needs to remain a top priority to mobilize the additional $125 trillion that are needed to get our world to net zero by 2050. And as far as Europe is concerned, she said that Russia's aggression has not only underlined the need for the EU to become energy independent, but also the need to move away from fossil fuels. And Kris Peeters from the EIB followed that up with truly a rallying call that sustainable finance has the tools and means, and it's time for it to break through, and that the EIB has indeed shown the path as the EU's climate bank and the largest multilateral development issuer with the most SAB, so sustainability-linked bonds and climate awareness bonds out there, and also leading the way in setting the bar for meeting those sustainability criteria. And then from the regulator here in Luxembourg, Claude Marx highlighted key pieces of the evolving regulatory architecture that we see for sustainable finance, not just in Luxembourg, but around the globe. And that is from the beginning of 23 onwards, the RTS for the SFDR, the regulatory technical standards for the disclosure regulation, and then also for non-financial businesses, the so-called CSRD. And he pointed out that there are 3 hot topics that regulators and indeed the financial sector needs to keep an eye on. And that is 1, greenwashing in light of growing investor demand and sustainable financial instruments, and ESG ratings and the need for reliable data sources for those very ratings, and then integrating climate risk into internal models and governance. And you will hear throughout the next 2 hours that these 3 themes will keep reverberating. And in that context, allow me a few observations that I made yesterday as I was listening to everyone and then digested their input afterwards. And all the arguments we were having about getting regulation right and getting the sequencing of regulation right, the discussion about interoperability between the different taxonomies around the world, the hunt for good actionable data, and the striving for that investment integrity. We are having these arguments because there is momentum for sustainable finance. There is a collaborative determination to get this done, and that gives me tremendous hope. And you heard it also from Jennifer Wu as she was talking from the investment perspective, and from Genuino Christino, the CFO of ArcelorMittal, who spoke from the perspective of the heavy industry. And they have a long journey ahead to get that transition right. They said, this is for the long term, and we need to just be clear about what we're doing. And so in that context, Jennifer said COP27 in Egypt coming up in November will be a reality check for the markets and for the governments to understand where we are in terms of delivering on those net zero targets. And she said also that while we are looking for investment opportunities to bring down emissions, we also need to look at climate adaptability. That is a topic that's been a little bit overlooked in the forum where we discuss investment strategies and opportunities, because as we've seen through the extreme weather events in Europe and around the world, communities right now and here need to protect themselves already against the impact of climate change. And so today we look again at many of these topics, but we look a bit beyond climate finance. Because as the finance minister said yesterday, green and social are the 2 sides of the same coin, of course. And so in this vein, we'll address the rise of the S and the G in ESG. And we'll follow that up with an update on a study that Luxembourg for Finance commissioned 2 years ago about financial services and human rights. And then, of course, after hearing so much about the need for good data, we'll have a true data expert coming on today who will take us to where and how we can get to that good and actionable data that we need for our ESG investing and to make those sound decisions to channel capital into sustainable economic activities. And we'll look indeed also at the sustainable finance toolbox that is ever expanding and the product development and the demand that sits behind it, because we've so much further than just green bonds. And then we'll look at the future for labeling, which is also quite an important issue to what I referred to a little bit earlier in the remarks of the regulator, because regulatory authorities have become quite strict in terms of looking at that greenwashing and adhering to sustainability criteria. And we'll discuss, of course, also the importance of the EU carbon markets for the transition to a Paris-aligned economy. You may remember Genuino Christino pointed out how important that market is specifically for those hard-to-abate sectors. And then we'll conclude with a look ahead for the future of sustainable finance. So, our first keynote speaker for today is someone I admire enormously. She's a familiar face for the audience of the Sustainable Finance Forum and a passionate advocate for sustainable finance with truly a global reach. Julie Becker, the CEO of the Luxembourg Stock Exchange. And I should add, she's the first woman in this role in the 90-year history of the institution. Before taking over as a CEO in April last year, she served as Deputy CEO since 2019 and as member of the Executive Board of the executive committee, since 2015, and in 2016, and that's also been crucial for developing sustainable finance here in Luxembourg, she founded the Luxembourg Green Exchange, the world's first and leading platform entirely dedicated to sustainability-focused securities. And as member of the high-level expert group on sustainable finance, she also has been helping to shape that EU regulatory architecture on sustainable finance. And as chair of Lux CMA, she's giving a voice to the stakeholders of the capital markets industry in Luxembourg. So a warm welcome to you, Julie. It's a pleasure to have you with us. Over to you.
Thank you very much, Judith, and a very good morning to everyone tuning in today, wherever you might be in the world. It's a great honor for me to be the opening speaker at Day 2 of the Luxembourg for Finance, Sustainable Finance Forum 2022, a forum that I very much look forward every year. And especially as this year, the title of my speech, as Judith mentioned, reflects a topic close to my heart, the growing importance of S and G when it comes to ESG. Let's first take a step back and look at how this massively popular term came to be. The United Nations Environmental Programme Finance Initiative, or UNEP-FI, is widely considered to have coined out the term in a report from 2004. So I should add that some experts place the concept of ESG as far back as the 1960s, when some investors began to actively exclude tobacco companies and or apartheid-affiliated companies from their portfolios. So if the idea of ESG can be dated back that far, why are the S and the G of ESG truly being brought into the spotlight only now? This is a highly interesting question that we spend quite some time discussing at the Luxembourg Stock Exchange, because we have seen firsthand how some of the weight has shifted from the E to the S and the G of ESG over the past few years. And when I started preparing for this speech, it immediately became clear to me that I needed to focus on the G for governance. It's often the least visible of the three letters that make up ESG, but it is by far the one with the biggest impact on the other two. As I went for a walk to structure my thoughts, I called my team. And I told them that it's really a pity that ESG is not written GSE, to make it clear that it all starts with governance. That good governance is a driver of positive social and environmental impact. Likewise, poor governance is what fuels social injustice and environmental disasters. Interestingly, my team told me that apparently Patrick Clemens-Hunt, who was heading UNEP-FI when ESG was established as a term there, later said that they considered calling it GS to elevate the importance of corporate governance in this equation. However, they landed on ESG as it was a more catchy term. But even if governance may be perceived as less catchy concept than widespread social issues and environmental emergency, I will bring the G to the fore today. If there's one thing I would like you to take away from my speech today, is that all starts with good governance. Because meaningful social and environmental change depends on our ability to improve governance everywhere. We need good governance to make the right decisions on S and E issues. Better managed companies are more likely to make strategic decisions that make sense long-term, including when it comes to incorporating ESG issues, meaning ESG risks and opportunities into financial and operational decisions. Good governance is about fighting corruption, addressing conflicts of interest, reducing the risks of money laundering, securing good working conditions in its supply chain, improving transparency, and the list goes on. It's about being aware and assuming responsibility for the impact that a company or institution has in the society, and deciding what contribution it will make when it comes to our global challenges and our global goals. Good governance starts with having the right people in decision-making positions. Over the past few years, there has been a renewed focus on improving diversity on company boards. With more diverse boards, more perspectives and stakeholders will be considered when important decisions are made. With more diverse boards and teams, companies will be able to better identify new opportunities and adapt to new challenges and priorities, such as developing solutions to combat climate change. More diversity makes companies, as well as governments, healthier and better prepared for the future. I would also like to say a few words about a new megatrend which both reflects and contributes to good governance, namely gender finance. Gender finance consists in financing projects which support gender equality and women's empowerment in different ways. Women are still, to a large extent, excluded from the global financial system, and even from basic financial services, such as the opportunity to open a bank account. Gender-lens investing is about investing in projects that benefit girls and women, such as financing women-led startup or educational program for girls, or other efforts to advance the gender equality across the world. I'm convinced that with more women included in the global economy, with more women in decision-making positions across all sectors, we will see an immediate effect in terms of both social and environmental impact. As the old saying goes, when you empower a woman, you empower a village. To the point I made earlier, governance empowers positive social and environmental change. Now to the S, or social. In her opening speech yesterday, Luxembourg Minister of Finance Yuriko said that we are facing a triple crisis: the energy crisis, the cost of living crisis, and the global food crisis. Minister Backus went on to say that in such a context, green and social are two sides of the same coins. The minister is right. And today I'd like to illustrate how the E, the S, and the G only work when linked together. When sustainable finance first emerged as a concept in 2007, it was all about green. And it took several years before the social dimension was given any attention at all. 8 years passed from the first green bond was issued by EIB in 2007 until the first social bond was brought to the market in 2015 by Instituto de Crédito Oficial, ICO. The S of ESG enjoyed a tailwind when the traditional focus on shareholders' capitalism gave way to a new focus on stakeholder capitalism. The idea that companies need to consider their impact on different stakeholders and not just on making money for their shareholders. And then came the pandemic. 2020 was undoubtedly the year when the S of ESG was brought center stage. It's true that the pandemic accelerated our awareness of the climate crisis, but as importantly, it also made us aware of the inequalities in our societies. Hospitals were at full capacity. Schools moved to the virtual classroom. Millions and millions of people were under strict lockdown for weeks on end, and many realized, perhaps for the first time, the true value of frontline workers. It became painfully clear that some communities and some countries were much harder hit by the COVID-19 pandemic than others, And the same is true for the devastating effects of climate change. We are all affected by the global challenges facing the world, but vulnerable populations pay a much, much higher price. When the pandemic hit, we saw an immediate and steep uptick in social and sustainability bond issuances. At the end of 2020, social bond issuances had grown up by 1,000% compared to 2019, both globally and on our exchange. We continued to see frequent social bond listings on our exchange throughout 2021 as well, including the social bonds issued by the European Commission under the historic EU share programme. Green bonds are still the leading category of sustainable bonds. However, there are clear signs of a growing appetite for other investment opportunities that tackle social and governance issues as well. And sustainability-linked bonds, or SLBs, are the fastest growing sustainable bond category this year. And we see some interesting examples of how issuers can use the innovative structure of SLBs to enhance both the E, the S, and the G of their company and operations. Let me illustrate this with an SLB example issued by the Swedish investment firm EQT in 2021, which is listed on our exchange and displayed on the Luxembourg Green Exchange. With this issuance, EQT sets out 3 KPIs. First, measurably reducing its greenhouse gas emission. That's the E, its environmental KPI. Second, increasing the percentage of women in investment advisory roles. That's the S, the social KPI. And finally, increasing female board members appointed as its portfolio companies. That's the G for governance KPI. As illustrated throughout this bond, we need to address the full scope of ESG as we work to transform the global economy. But this is, of course, easier said than done. Social is a vast and complex term. It's difficult to define and even more difficult to measure. How do we count hunger? How do we count poverty? Or the human cost of living in crime-ridden neighborhoods? How do we get to a definition, a universal definition, of what constitutes good healthcare or education? And who should be allowed to benefit from affordable housing? At this stage, years of discussion have gone into the draft EU taxonomy, which is a green classification system establishing a list of environmentally sustainable economic activities. The exercise of establishing a social taxonomy is likely to be even more complex and time-consuming. The EU taxonomy goes some way in interlinking environmental goals with social safeguards. And by doing so, it highlights, and that's important, the fact that environmentally sustainable economic activities cannot be deemed green if they have a direct and negative impact on social issues. This is a very important development, an essential message. Still, we need a social taxonomy because taxonomies offer clear definitions to eliminate misinterpretation and exploitation, help reorient capital flows towards sustainable development projects, and foster investor trust and education. Also put on hold for now, in the final report on social taxonomy published by the European Commission's Platform for Sustainable Finance in February 2022, interesting suggestions are made to reach these goals. Other regulatory developments, such as the Non-Financial Reporting Directive and the proposed Corporate Sustainability Reporting Directive or the Corporate Sustainability Due Diligence Directive, are shaping a new era of transparency and disclosure on a broad range of ESG topics. Similarly, the Task Force on Climate-Related Financial Disclosures, the TCFD, specifically asks for proper governance of climate-related financial risks, showing that the G plays a key role in securing the E. It's not just lawmakers and regulators that are scrutinizing non-financial aspects of companies. Investors and the general public are paying attention too. In a recent survey on sustainable finance knowledge in Luxembourg, led by the foundation ABBL, the Banking Association in Luxembourg, the CSSF, the Luxembourg Financial Supervisory Authority, and LSFI, the Luxembourg Sustainable Finance Initiative, respondents indicated that respect for human rights was the third most important criteria when making an investment decision, just after return and risk factors. Companies in all sectors should take note. A just transition can only become a reality if the E, S, and G are given equal rates and consideration. If poverty is not eradicated, for example, children will not receive the education they need and may be forced to exploit natural resources to earn a living by companies that lack good governance. A just transition is about greening the economy in a way that is fair and inclusive for all affected groups, with a focus on creating decent work opportunities and leaving no one behind. The growing importance of G and S, whether that is in finance, business decisions, or in the rise of conscious consumer, shows that we as a global community have come to the realization that without good governance and without reducing social inequalities, we will not reach our climate goals. We must act to ensure that the three key areas of the EU Green Deal, covering and interlinking ESG, are achieved. The future we are building will stand or fall on the actions we take today. That's why we must place ESG at the heart of global finance and start with G for governance. Thank you very much.
Thank you, Julie Becker, the CEO of the Luxembourg Stock Exchange. And thank you, Julie, for giving us the cue for our next topic indeed. You heard it, human rights as third most important topic in the financial industry in Luxembourg. And our next two speakers will indeed give us an update on a baseline study that Luxembourg for Finance commissioned 2 years ago on how financial institutions are integrating human rights into their core activities. Of course, back in 2020, the world was dealing with the fallout of the pandemic, and now the context is somewhat different, if you will, amplified in terms of a confluence of multiple crises, and that, of course, has an impact on how human rights are focused upon. So to present the results of this study, I have the pleasure to welcome back to the Sustainable Finance Forum Professor Dorothée Baumann-Pauly. She's the director of the Geneva Center for Business and Human Rights at the University of Geneva. And joining us from Berlin is Cecilia Barral Diego, head of the legal research team at Löning Human Rights and Responsible Business. So warm welcome to both of you, and over to you, Dorothée.
Thank you, Judith, for your kind introduction and for framing our work. Let me build on that and provide some more background on what motivated this study. So at the Geneva Center for Business and Human Rights, the institution that I direct, we want to support companies in advancing human rights in practice. Financial institutions are key institutions that through their own core business operations, investing, lending, advisory services, can set powerful incentives for companies to conduct business in line with international human rights standards. Based on this premise that financial institutions are key actors for advancing human rights in practice, we were asked in 2020 by Luxembourg for Finance to assess the role that human rights at financial institutions play in Europe. So to prepare a first ever survey of European financial institutions on human rights, We conducted over 20 expert interviews at the time, and based on the experts' insights, we then constructed a questionnaire and shared it with financial institutions in Luxembourg, Germany, the Netherlands, Switzerland, France, and the UK. From this outreach, we received data from over 100 financial institutions. The results at the time were somewhat surprising. Even in 2020, a large majority of financial institutions already fully agreed that human rights are a topic that is material for financial institutions. This was surprising because it demonstrated foresight. None of the legislations that have come into effect now had been effective back then, for example, the EU taxonomy. My colleagues at the Geneva Center and at our partner organizations, Löning as well as Finance and Human Rights, were excited that in 2022, Luxembourg for Finance invited us again to redo our survey and measure progress against the baseline data from 2020. The detailed results that my colleague Cecilia from Löning will present to you in a moment are again surprising, and they are reassuring. The industry shows unwavering support for human rights, despite or maybe exactly because of the fact that the world has changed dramatically since 2020. The climate change emergency is felt more than ever after another record summer this year. The experience of the pandemic clearly left scars on organizations and individuals, and recent geopolitical shifts in Europe due to Russia's war in Ukraine have been questioning the stability of our world order. What we can see from this year's survey insights is that human rights, more than ever, are considered relevant for business success. Integrating human rights in core business operations at financial service providers, banks, and asset managers is also no longer optional. It is expected by citizens, and it's now also legally required. Together, legal and non-legal forces are key drivers for human rights. Most remarkably, probably in the context of S in ESG, the social component of environmental, social, and governance data that is increasingly becoming mainstream for investors in Europe. I'll now ask Cecilia to share a few slides and present more detailed survey findings.
Thank you, Doro, and hi, everyone. I will present to you the highlights of our study and also look at what has changed since 2020 when we did the study for the first time. Let's start with the importance of human rights for the industry. The good news is that finance professionals' awareness of the relevance of human rights remains high, and they agree that the industry plays an important role in creating a more equitable society. As you can see in the pie chart, over 90% of the survey takers agree or strongly agree with that role the finance industry has. There is almost consensus on this matter. This high level of awareness across finance professionals when it comes to the importance of human rights is also evident in the next finding. The link between human rights and financial institutions' fiduciary duty remains also strong. At the organizational level, 85% of respondents agree or strongly agree with the statement that human rights are associated with financial institutions' fiduciary duty. This means that human rights is considered a topic that can have an impact on their business success. Here we observe an increase in the number of survey takers that agree with the statement compared to 2020 results. Finance professionals continue to believe that addressing human rights is associated with mitigating organizational risks. What are these risks? We observe that the top two risks are risks to companies' reputation and the risk of infringing on individuals' rights, followed by regulatory risk. The order of importance has remained the same as compared to 2020. When it comes to opportunities, most respondents agree that addressing human rights concerns is compatible with better financial performance for the organization, their client, and other investee companies. The next finding I would like to share with you is about the drivers. What are the main drivers that encourage the finance industry to address human rights? And here, as you can see in the graphic, we observe that the key drivers are regulation, followed by clients and employees. This is an interesting development I would like to note, as in 2020, clients and employees were considered the main drivers, and regulation was sidelined to the fourth position. This development could be due to the fact that many regulations, mainly at the EU level, have entered into force, triggering the need to address human rights in a more concrete manner. Companies are starting to implement this regulation, and so more and more people in financial institutions are becoming aware of these requirements. And it is not a surprise that we have regulation as the top driver. We also observe that additional factors such as the COVID-19 pandemic and geopolitical issues such as the war in Ukraine are accelerating the need to address human rights. Over 70% of respondents agree that current geopolitical issues will enhance the focus of the Organization on Human Rights, while more than 50% of the respondents agree that the COVID-19 pandemic has enhanced the focus of the Organization on Human Rights. Let's take now a closer look into regulation as a factor. Here we observe that while finance professionals believe the industry plays an important role in addressing human rights, almost 90% of respondents still emphasize the fact that the government has a duty to ensure the respect for human rights, and this should not be left to voluntary initiatives alone. Governments should set clear legal standards. We observe here an increasing support for this position, up from 75% in 2020. Financial institutions support the government's regulatory agenda in this regard. Let me add something about obstacles before we move into the final finding I would like to share with you. When it comes to key obstacles to addressing human rights when engaging with clients and investee companies, we can say that these are mainly associated with a lack of time and lack of knowledge. Budget constraint seems to be now more of a concern in relation to engagement with investee companies. This was not the case in 2020. And finally, what I would like to share with you is to talk about the needs. What do financial institutions need to better address human rights in the organization? And we observe, first, that financial institutions still need better company data on companies' human rights actions and impacts, including those in relation to their supply chain. I'm saying here still because in 2020, we also identified this as one of the needs. Second, they need more harmonized disclosures by companies. Companies report on their activities in different formats, data sets, standards, and this is probably challenging to compare the data. These top two answers were followed by the need for a clear understanding of what is expected of financial institutions, and equally important, the need for more human rights trainings for employees in the finance industry. It is worth noting that the need for a clear understanding on how to implement regulatory requirements is now higher in the ranking as it was 2 years ago. This could be explained by the fact that financial institutions are currently undertaking the implementation of regulatory requirements and may be facing practical challenges in this regard. This could also be as a result of the increasingly lively debate on, and in some cases, the adoption of corporate human rights due diligence legislation in Europe at both regional and national levels over the last 2 years, triggering the need to address human rights-related topics in the business context. So these are the key insights that I wanted to share with you today, but there are many more interesting findings in the report, and I invite you to take a deeper look at it. I would like now to turn back to Doro for the concluding remarks. Thank you very much.
Thank you, Cecilia. So I think the data speaks for itself, but let me offer a couple of concluding remarks. So first, clearly, legislation is now a key driver for human rights at financial institutions, and these legislative requirements are just kicking in. So we expect even stronger effects of legislation as a driver for action in the years to come. Second, compared to the first survey, respondents this year strongly highlighted the need for greater implementation guidance. Why is this? Well, now that financial institutions have started the implementation process, many might realize that it's not so easy. Translating human rights commitments into everyday policies and standard operating procedures takes time and effort, and many respondents ask for further support. So what are the implications from our research insights? We summarize these in the form of 6 recommendations to financial institutions and their trade bodies, as well as to lawmakers, companies, and clients. First recommendation to financial institutions is that they should build organizational capacity for advancing human rights in corporate practice. This implies allocating adequate resources, investing in building expertise on human rights, and assigning clear responsibilities for human rights at all levels of the organization. Financial institutions should also use the legal duty to report as a strategic tool to drive further implementation. So not reporting for reporting's sake, but as a hook or milestone to advance actual implementation. We also believe trade bodies should continue taking on a proactive role. This way, no financial institution needs to do this alone, but resources can be pooled and expertise on the implementation of human rights in corporate practice can be shared. Lawmakers clearly have a role too. They should create consistent and clear regulatory standards at the European level. And the companies should strive to provide meaningful and accessible data. One key obstacle for financial institutions remains the access to better human rights data from companies. And finally, every one of us, also clients, should continue asking for sustainable finance products that integrate human rights considerations. To conclude, let me thank Luxembourg for Finance for their continued interest in our work. And I want to thank my partners at Löning and Finance and Human Rights, because it's such a joy to work with them. We look forward to receiving your reactions to our study. After all, getting hard data on the status quo of human rights in financial institutions is just the beginning, and we stand ready to support you in the implementation process. My core business is education, and we also offer training jointly with Löning. We also plan to continue measuring progress over time, and we hope to be positively surprised over and over again with concrete success stories of making human rights an integral component of finance. With this, I thank you all, and back to Judith.
Terrific work. Thank you very much, Dorothée, Baumann-Pauly, and Cecilia Barral-Diego. And of course, you can access the study and read through the material and the insights right here on the website of Luxembourg for Finance. The link should have gone live as we speak. But don't run away, because we have more really vital information coming up, because the cue was already just given several times. Meaningful, accessible data. That is what the industry is reaching for, and our next speaker is a true data expert, Sherry Madera. She is at this time Senior Vice President at MasterCard, where she's in charge of public policy. Before joining MasterCard, just in March this year, she served at the London Stock Exchange and at Refinitiv as Chief Industry and Government Affairs Officer. And crucially, she chairs the so-called the Future of Sustainable Data Alliance, which is a collaborative body that was conceived in 2020 in Davos by Refinitiv, the World Economic Forum, the IIF, and many other stakeholders for that very reason, to get to meaningful, useful data accessible to everyone for sustainable finance. So a warm welcome to you, Sherry, and over to you.
Thanks very much, Judith, and thanks for having me at the Luxembourg for Finance event. I think this is a really important time to gather, and certainly I know it is a global audience being gathered by a global financial center, so great to be here. Again, you know, I'm looking at data and thinking about its role within the sustainable finance community. And I would like to make sure that we're not solving the world's problems here in the next few minutes. Hopefully we can all do that together in short order. But really, I'd like to leave you with some food for thought and how it is that data plays a role and how data is part of the solution for sustainable finance. And the reason why I mention it that way is I'd like to dive right in. Recently, I think that we've been experiencing, especially in the media, something called the war on ESG. ESG being environmental, social, and governance data in this regard. And I think that what this stems from is really a growing chorus that the financial community is saying that we really need more data. We need better data. The quality of the data isn't there. I can't find what I need. I don't have all of the data points I need, etc. And I think all of that is absolutely true. However, I also think we need to understand what we are really calling for. Do we really want more data, or do we want better data matched to use cases? And just taking a healthy step back, we need to think about why this is the case. And I think part of this is the exuberance of the financial community to be involved with such an important issue, such as tackling climate change and thinking about how we create a just transition. The issue is so enormous, it makes a lot of sense for the financial community to be that involved. But perhaps what has also happened is a misstep in sequencing. So there has been a huge amount of regulation, standard setting, drives towards mandatory disclosures globally, but in particular in the EU. I think that we can call out the EU as at the forefront of putting some structure from a regulatory and policy making perspective on the financial community as to what it is we're doing to engage with sustainable finance. And all of that should be applauded. However, creating the framework by which we're going to get clearer, creating the framework by which we can measure so that we can manage and that the financial community can be part of the solution does require data. And some of that data is not being disclosed at the same sort of density or level that is needed in order to adhere to the use case of complying to the sustainability measures becoming in place and are proposed for the next few years. So really the exuberance and the movement forward from a regulatory perspective has led that disclosure of the data. And in so doing, there's a misstep. And so therefore, we do need to have a little patience for things to catch up. Even just the end of this year, we're going to be seeing a lot more disclosure that's coming from issuers in order to feed into the use case, which is making sure that we've got a nice transparency to match up to the regulations that are already in place. Is that going to change on a dime? Is that going to move very quickly across all asset sets, asset classes, all issuers? Probably not. And so again, we need to be mindful of how it is that we can make sure that we're doing our best to comply there, but also not put all the burden of disclosure on the issuers. Again, those companies, organizations who are seeking to access the capital markets, seeking to access finance to grow, which of course most of our economies desperately need now post COVID, we're really, they will be stretched and it will be costly for them to produce data at volume. So the question is, how much data do we need and which data sets are absolutely essential? And trying to build that density there maybe perhaps should be our new call to arms, as opposed to more data, but more data that is going to be applicable to more use cases globally. If we think about sort of, what it is we want from data, really, actually what we need is data that is coherent, comprehensive, and comparable. The 3 C's, I call it the 3 C's of data. And if we can continue to push for that, not only within an industry, not only within a geography, but globally, then I think that we're in a really good position in order to be able to match not only the compliance and frameworks and labeling use cases that I referred to, but really why it is we're doing all this. Why we're doing this is trying to move capital at scale to sustainable opportunities and move it perhaps away from areas that are going to continue to damage the planet and damage sort of our social frameworks. So if we keep that big goal in mind, then actually, again, we should be identifying the building blocks that go into creating that coherent, comprehensive, and comparable data globally. I believe that there's been a deeper dive already about thinking about convergence versus divergence in standards. And the reality is that actually, if we're looking at taxonomies as one example, there are 28 different taxonomies that are either launched or in development at the moment globally. And that's from a study that the Future of Sustainable Data Alliance has put out, and an update is coming later this year. But also the Carbon Disclosure Project, CDP, has put out a very recent outline of taxonomies. And this sounds like we're going in the wrong direction potentially to some people. When you hear 28 different taxonomies, that might seem like an incredible amount of divergence. The reality is it really reflects what countries are looking to achieve. And that's not going to be completely comparable because each country has a different makeup and is trying to encourage money into the areas that are going to make the most difference for them and for the planet. So actually, at FOSDA, we would love to have a coherent and single taxonomy as one example of where we want to go. But I also don't think that's happening anytime soon. So what is it that we can do as a global financial community in order to be able to start moving towards more clarity and transparency globally? And of course, you would forgive me by saying that data is the answer here. If we get very, very specific about what data sets feed into each of these taxonomies, each of these frameworks, each of these standards, we can be much, much closer to interoperability, and perhaps even if harmonization at the top level isn't going to be delivering to us a single taxonomy, at the very least, we're going to be able to use that data to make it interoperable between various taxonomies. This is essential when you're thinking about global financial systems, when you're thinking about multinational companies who are participating across different jurisdictions. So again, that data set becomes incredibly important. And if that data set starts becoming mapped to various different use cases, be they my example of taxonomy or standards, those data sets are also going to be able to be part of alpha investing strategies, being part of how investors are deploying their capital. And so those data sets are really, truly becoming foundational building blocks for sustainable finance growing from there. And I think that that's important to dwell on for a moment, which is that those data sets are really those building blocks upon which we build our house. And our house being sort of that financial structure and system that is going to be able to deliver sustainable finance. So I think we would all agree, we would want the houses that we've built, the houses that we live in with our families, to be very, very strong at their foundations. And again, this leads us back to those data sets that we're going to need to build density and quality in. And calling out sort of that worry that data isn't, quote, good enough, end quote. Again, I think that we need to be very clear. As we're growing, as these phases, as the structuring and the sequencing of sustainable finance moves forward at pace, data is being demanded at a rate that isn't necessarily being disclosed from raw data. And there's a very transparent method within the data community to also highlight where there are estimations, extrapolations that are in the data. And that is already incredibly transparent within the data community. And it's absolutely essential to make sure that those things aren't considered errors. And those are the 3 E's, I think, that we all just need to be very aware of. We have our 3 C's, which is something we really want to go for, which is we want coherent, comprehensive, and comparable data. But what we want to be very conscious of is that the 3 E's, estimates, extrapolation, and errors, are what we need to be very conscious of being part of the data growth story. And as long as there's transparency there, we can avoid creating risk right at the ground floor, right in those foundations of what we're trying to build on top of that. So if we get those data building bricks strong, clear, transparent, we can build anything on top of that. So again, we don't want to have an enormous amount of those bricks as being required today. We need to phase the requirements of what it is that we're going to be using those data bricks for, so that we can actually create interoperability between use cases and know that we have truly dense, truly useful data at that foundation level. So really, if we don't have that, the expectation is a bit of a worry. And this is something that we're hearing along the lines of sort of when we're talking about our war on ESG. There's also a little bit more resistance to embracing some of the fantastic standards that are already out there. I mentioned taxonomies, but this also carries through to all the different regulatory and standards that are out there. If we look at SFDR for the asset management community in Europe, it's a great example of where it is that funds are trying to match their percentage makeup to the requirements of SFDR. And there's a growing resistance to label funds as green, as sustainable, as impact, etc. And if we just take a moment to think about that, actually all the incredibly good hard work of experts that are building up these frameworks, they may actually be put aside if no one uses them. So I think we should start thinking about how is it that we can really make sure that data empowers the use of what is out there. Otherwise, what we're doing is we're creating an increased risk to the financial markets because these great frameworks are not being adhered to, not because they put the words out there and are uncompliant, but because they're choosing not to actually label their funds in a way that's going to be more transparent to the investment community. Something for us to watch and something for us to be aware of. And perhaps data, again, can help be a bit of an unlocker. Great clarity in quantitative data sets means that you're going to feel much more confident about using them to talk about your compliance or your adherence to certain ways of labeling funds, labeling what it is you're doing with your financial investments. So we've talked quite a lot about sort of the in the weeds, the detail of the financial stack, the financial ecosystem. But I'd like to put out there some bigger picture thoughts. We're nearing the lead up to COP27 later this year in November, and I was delighted to be part of COP26 last year in Glasgow. And COP26 came up with a lot of net zero targets. There was a huge amount of target setting, huge amount of commitments that came out from the country level, the country level, the company level, and organizations all the way through the stack. But what we're now seeing is that the UK has successfully been challenged for failure to confirm the targets will be met for their net zero targets. And again, data plays a role in this as well. So understanding how it is that everyone within a geographical community, within a company, or within an organization needs to contribute to those top level net zero targets is becoming more and more urgent. Because the time frame between now and those net zero targets, 2030, 2040, 2050, that's a long time frame. But if we don't understand what we're measuring, what it is that we're using as data sets to give us an idea of how things are moving in a direction, we're going to have a hard time course correcting if things are not going in the direction we're looking for. So even right at that top level about net zero commitments that are far, far in the future, we need to think about what data sets we need today to manage that, and also that tricky element of what forward-looking data we might need. And again, this is something that central banks are really thinking about already for their prudential regulations of understanding how is it that portfolios are going to have a risk impact in the future. That's hard, because we're not talking about verifiable raw data that has happened in the past and can be audited. We're talking about linking predictions to the future. And some of those predictions need to be linked to data sets that are completely outside of what a company or a country even can submit. These are climate-based numbers. These are nature-based numbers. These are impacts on the earth and the surface. So if we don't get those data sets right and agree that they are the ones that are going to be utilized in order to be able to make some predictions and assumptions going forward, we again are building some of our future plans on shaky grounds. I'm not worried about this, though. I think that we can absolutely get there because the financial community has been doing this for decades. We always have predictions that are part of financial projections, thinking about what's going to happen to a company's life cycle in the future. It's fundamental to finance. But what we need to make is we need to make that data and those really true data sets that are going to be linking our future into the absolute fundamentals of sustainable finance. Otherwise, our predictions are going to run into some challenges going forward. So finally, we've talked a lot about moving capital at scale. I'd really like to also remind us that we can move capital at microfinance levels. Some of what we're talking about today has been driven by investor demand. It's been driven by the retail investor. It's been driven by thoughts on how it is we protect the way we live in our planet going forward. We also should be giving that empowerment by data to the conscious consumer who are looking at making choices every day in terms of how they deploy their capital. And of course, that might seem small, but actually every small choice adds up. So all the things we're doing from the top down can be met with those things that are happening from the bottom up if we use that data also to support conscious consumerism. So I think that hopefully I've given more food for thought. The title of this is that we're swimming in a sea of data. And I guess my message is that we are going to keep swimming. It's a difficult, and sometimes the tides are high and the waves are high. But I don't think that we're in any danger of drowning. And certainly I think that the data is going to be able to be a real lifesaver as we move forward. So thanks very much, Judith, and look forward to the rest of the day.
Thank you very much, Sherry, for this insightful take on data. And I feel quite hopeful after listening to her. Also, my two key takeaways from Sherry were we don't necessarily need more data, but data that is coherent, comparable, and comprehensive, and also focus on specific data that builds that density that we can stand on and invest in a sustainable way with confidence, much like building the foundations of a house. I find that quite helpful, that image. So leading on from the need for reliable and actionable data, our first panel will take it a step further and discuss what we're doing with that data, which is building financial instruments. So how is that sustainable finance toolbox expanding? It has expanded well beyond those green bonds, what is driving product development and demand and so forth. And our moderator for this panel is another journalist from the Financial Times, Adrienne Classe. She reports on the asset management industry for the FT. So warm welcome to you, Adrienne, and over to you and your panel.
Thanks very much, and welcome to our panel on the Sustainable Finance Toolbox. Interest in sustainable investing has exploded in recent years, and as with any new industry, the tools available are still being developed. Green bonds have been around for some time and are widely used. However, a range of new innovations are coming on the market, which we'll discuss today. On the debt side, sustainability-linked bonds and social bonds are gaining traction. And for fund managers and their investors, Europe is leading the way on sustainability standards with SFDR Article 8 and 9 funds coming to market. How and when are these different solutions used, and how do they match with product lineups? Our expert panel will explore these topics. So without further ado, let me introduce Florent Deixonne, who is Head of ESG Regulatory Strategy at Amundi, Denise Delaney, Head Responsible Business at Liberty Specialty Markets, and Ross Keeling, Origination Director in the Sustainable Finance Europe division at HSBC. So welcome to all of you, and thank you for being here. To kick things off, I'm going to start with you, Florent. So flows into ESG have boomed in the past couple of years. In Europe, how important has the implementation of SFDR been to this? And before you launch into that answer, maybe a really short definition for those who may not know what SFDR is.
Yes, thank you very much, Adrienne. Good afternoon, everybody. So on the first part of your question, basically speaking, SFDR is a big deal for ESG because it's the new norm. And since the enforcement of the SFDR regulation in March 2021, asset managers are using Article 8 and 9 as a signal of the ESG credentials of ESG products. And we could even say that the SFDR framework could be compete a little bit the national ESG labels. EU ESG asset under management are booming since the implementation of the Article 8 and 9 SFDR categories. And if we are referring to the Morningstar figures, Article 8 and 9 asset under management reach a record high market share in the second quarter of 2022. More than 50% of the EU funds asset under management are now claiming to be ESG. So the SFDR Article 8 category currently accounts for around 90% of the ESG funds versus 10% for Article 9 funds. And in terms of product development, obviously, the launch of Article 8 and 9 funds represent more than 60% of total new funds in the EU over the period, and obviously we expect this pool to enjoy continuous growth thanks to the launch of new products directly under Article 8 and the upgrade of Article 6 products to Article 8. So in this huge context, and referring to Morningstar figures, Amundi came out on the top with 6.5% of Article 8 and 9 market share. And the second part of your question, and what is the difference between Article 8 and 9 funds? So as you know, the Sustainable Finance Disclosure Regulation created, amongst others, two categories of ESG-related funds, Article 8 and Article 9, and the funds available for sales in the EU have been classified by fund manager depending on their sustainability objectives. So you have Article 9, the dark green, the most demanding category. Article 9 funds must have a sustainable objective and demonstrate how this objective is achieved. And by definition, Article 9 funds is only invested in sustainable investment. On the other side, you have Article 8, the light green, and that funds promote ESG characteristics in their investment process. And you have Article 6, is all the other funds that are not categorized under 8 or 9, and those Article 6 funds cannot be marketed as ESG.
Thank you very much, Florent, for that overview. Moving to a different part of the financial services sector, Denise, I was wondering if you could talk to us about how sustainability and ESG are being integrated into Liberty's underwriting considerations. How does that work and what does that mean?
Sure, thanks so much, Adrian, and thanks for having me. And perhaps for further introduction and clarification, Liberty Specialty Markets is part of Liberty Mutual's Insurance Global Risk Solutions division, and we're a leading provider of commercial and specialty risk insurance. And we really see insurance as part of the sustainable finance ecosystem, and though it's perhaps more obvious and understood that companies and projects need capital, and we're talking a little bit about investment, but we often find there's less awareness or appreciation almost for the need for insurance to make a lot of that possible. So we feel that we do have influence in terms of which organizations and projects we underwrite and how we do that, at what level, on what terms, etc. So when it comes to ESG being integrated, particularly into our underwriting considerations, which we're very active in, we're really trying to apply a consistent framework to assess material ESG factors within our underwriting process. So really looking at a client in the sector that they're in and understanding what's material and directing our underwriters to spend time on what matters the most. It may seem obvious, but I think there's so much that you could look at and consider in the world of ESG, and some of it will be less material than other factors. And it's really, we see it as a really natural evolution of our core underwriting philosophy. Insight and knowledge about an account or a risk is only going to be beneficial to us, and it's going to continue to need to be informed by reliable data, by technological and regulatory changes, and of course market forces. By doing that, we do try to take a really holistic lens, and by that I mean that we're there to support clients to make the right choices, to ensure the right assets and operations that will be perhaps better environmentally. And importantly, we hear this always from underwriters, that we need to balance considerations around the environmental, the social, and the governance. We can't be taking a single or mono lens to this. So we do recognize that there's a lot of complexity and nuance, and we think through that complexity rather than perhaps seeing it as too simple or black and white, in something that we can simply write rules around. So it's about empowering those underwriters with the right knowledge and insights to get to more sustainable decisions ultimately.
Thank you, Denise. Just a quick follow-up to that. I mean, in terms of the kinds of clients that are coming to you or the kinds of sectors that they're coming from and asking for your services, any insight that you can share with us on that?
Well, we operate in a really broad space in the commercial and specialty world. And so, there's lines like we insure everything from bicycles to aircraft and everything in between. And so given that breadth, we've continued to see demand across the whole of that spectrum. If I take an area like energy, for instance, we're certainly looking at both the ways in which we're going to need to respond to the market, and particularly not just traditional energy, but the renewable and perhaps more greener forms as well. We think that there's growth around both to be had, and that by, again, partnering with those clients to make sure that they're committing to transition and moving in the right direction, we can be there to support them. So we don't see it as in either or, but very much a both and in that energy space, for instance.
That's really interesting. Thanks a lot for that. Ross, I'm going to turn to you now for the banker's perspective. Where are you seeing the most demand for sustainable financing? What kind of projects, what kind of clients are you working on right now?
Thanks, Adrienne. And good afternoon, everybody. So I think probably the biggest theme in the last couple of years has been the rapid increase in demand for sustainability-linked products. So since the product first emerged in 2017, initially in the loan market, it's grown now to account for almost 20% of total issuance to date at about $750 billion. So green bonds, as you say, have dominated the sustainable finance landscape for several years, but sustainability-linked products are very much a rising force. And the attraction to issuers is on a number of areas. Firstly, these are not use of proceeds products. So sustainability-linked products are based on the issuer's sustainability objectives, and they're incentivized to achieve ambitious sustainability targets by typically reduced pricing and sometimes a pricing penalty for not meeting targets. I think borrowers like the product because of the ability to issue for general corporate purposes, but also it's a great way of clearly articulating your ESG strategy to stakeholders and being held to account then for that strategy by reporting performance against the metrics. I think we're seeing a very broad demand across that sustainability-linked spectrum. Typically in the sort of upper mid-sized companies upwards, and that's, there is a bit of work involved in structuring a sustainability-linked transaction, which makes it a little bit easier for those larger companies that have more resources. In terms of kind of areas of real interest at the moment, I think energy transition is a huge theme. We're seeing an awful lot of demand from, I guess, established technologies such as onshore, offshore wind, solar PV, but also emerging technologies, things like battery storage, green hydrogen, really beginning to get some traction. And we're seeing more and more projects in the energy transition space that are looking to raise finance. In terms of innovation and innovating products, I think the whole area of biodiversity and natural capital is a really, really interesting space. I think it's very quickly moving up on investors' agendas and borrowers' agendas as well. And I think COP15, which is coming up later this year, is going to help accelerate that. As will the emergence of new technologies like remote satellite surveillance to measure impact, and also the emergence of new standards so that investors can clearly measure and compare biodiversity impact. So really, really interesting time, I guess, in the evolution of the sustainable finance market. I think the broadening out of products and a broadening out of appeal across a wide range of issuers.
Sorry, I had myself stuck on mute there for a second. That's really interesting. I just want to follow up on the sort of natural capital biodiversity point, Ross. I mean, this is a really new emerging area right now, and one that is super interesting, but also could be seen as quite challenging just because, measuring biodiversity or natural capital would seem like really challenging exercises. How do you see that space evolving? What are the sort of new developments that you think are helping to sort of roll those kinds of products out or make them available to a wider number of companies?
Yeah, so great. It's a great question, and I think it's the key challenge in this area is really, it's relatively easy and scientific to measure greenhouse gas emissions, but measuring biodiversity impact is a lot more challenging. So I think we're at the point now where new kind of standards are emerging, and we have the new Task Force for Nature-Related Financial Disclosures, which hopefully will achieve the same as the TCFD has done for climate. But also I think the points I mentioned, Adrienne, about technology. So I think technology has a big role to play here in actually measuring and tracking biodiversity impact. I've seen some really interesting technology in that space. Things like, as I mentioned, the remote satellite surveillance, where you can track the impact of forestry projects and the impact of marine projects. So I think it's a combination of technology, science, emerging science and scientific standards around biodiversity, and also regulatory and disclosure standards. So I think watch this space. I think it's really going to be something that jumps up on the agenda, having been a relatively sort of forgotten point in the last few years. I think this is going to come right to the top of many investors and issuers' agenda.
Very interesting. Definitely want to keep an eye on. Denise, I want to turn back to you. We kind of touched on this a little bit before, but I wanted to know more about what kinds of sustainable or sustainability-linked products are most in demand from your clients right now, and if that's changed at all in the current economics, the point in the economic cycle that we're in right now, which is quite challenging for a lot of people.
Sure. It's very timely, as we just last week released a kind of a sustainable product showcase, and that's intended to really do just that, to demonstrate the host of services that respond to the sustainability challenges and opportunities and really advance resilience. To just give you a flavor for some of those, for instance, we were the first to commit to capacity to something called the Climate Transition Pathways partnership with Willis Towers Watson, and that's really at the leading edge of a first industry recognized accreditation model for those in the insurance industry. So if a customer is accredited, and that means they'll have science-based targets, they'll be aligned to Paris, etc., all determined by an independent body of experts and using credible methodologies, we will automatically offer them capacity. And we're looking for ways that we can kind of further support and incentivize those clients who are committed to an appropriate transition pathway and be a preferred partner for them. Even more recently, we were announcing a facility with Marsh around hydrogen. So we're, again, part of a world first for the insurance industry to provide a facility for hydrogen solutions. I think that's a really interesting example of where, when we can get involved early enough, we're able to really get the learning and the insight into those technologies to provide solutions and offer insurance capacity, because of course, as an industry, we look to historical data and rely on that quite heavily. So some of the newer technologies can be challenging for us to effectively support. And so that's really what we're committed to doing. And then if you look at, for instance, on the financial risk solution side, we've got projects supporting financing transactions for banks, which then have a real impact on some of the global economic development and sustainable infrastructure, particularly in the developing world. One of those is called the Green Guarantee Company, and with them we've actually helped develop a political risk insurance framework. So that's a basis on which insurers can then support the company, and ultimately we would be underwriting relevant political risks for guarantees for climate bonds that are issued and listed on the London Stock Exchange. That would then support bond issuers from, say, poorly rated or developing countries. So again, our role is often a bit nuanced. It's not that the most direct line to supporting that, but a really key one to make some of those solutions possible. I could go on, but to your second point around reflecting on the current financial climate, which we of course have to be on the pulse of, and certainly concerns around inflation, just to mention one, is keenly in our sights. But I think that we know, and our clients know, that many of these issues and topics within sustainability are here to stay. So we haven't necessarily seen huge retraction or anything there, and continued interest. And I think as an industry, we're just accustomed to needing to see around those corners to support clients and be not just risk aware, but really anticipate the risks that are going to hit their businesses and organizations. So I'm fairly optimistic in that respect.
Well, that's encouraging to hear, given humanity's tendency sometimes to think quite short term. Florent, I want to go back to you. So we talked about SFDR. We talked a bit about the sort of huge explosion of Article 8 and Article 9 funds under SFDR. I want to zero in a little bit more on Article 8 funds. So Article 9 funds are, as you say, dark green, the highest sort of standard of sustainability and ESG alliance. Are Article 8 funds a bit too broadly defined, and does that put them at risk for greenwashing?
Very interesting question. Basically speaking, I would say that to improve their product offerings since the application of SFDR, asset management companies have classified their funds and launched new products consistent with their interpretation of Article 8 and 9 requirements. But this new regulation, however, place many market participants in a challenging position. SFDR do not make clear how to qualify your product as Article 6, 8, or 9, or where are the frontier between these product categories, forcing each asset management company to classify and self-certify their own products. The key message is that, for sure, Amundi fully supports the EU initiative on sustainable finance, but the output of the SFDR regulations does not match the initial expectations. I would say that the initial idea was to make a sub-classification of funds with the following allocation objective: 85% of Article 6, 15-20% of Article 8, and a little of Article 9. In essence, we are moving toward the following: 50% of Article 6, 45% of Article 8, and 5% of Article 9. So Article 8 is becoming a melting pot. And the increase of the number of products under Article 8, which covers very diverse approaches and very diverse degree of ESG intensity, raises a potential risk which could lead to misperception of what is an ESG-driven investment solution, and is source of greenwashing attack for the asset management industry. The second message I want to share with you is that with the current lack of clear labeling standards, SFDR disclosure classifications are often used as an indication of the ESG credentials of a fund. However, this is not what they were designed for. And
Oops. Thank you, Florent. I want to also ask about the specific trend of pre-existing funds getting rehatted, so sort of reclassified as Article 8, Article 6 or Article 8 funds as being sustainable, basically, without sort of necessarily changing a huge amount about their strategy. Is that a trend you worry about in terms of concerns about greenwashing or dilution of the SFDR standard?
Yeah, you are right. There is a major reclassification within the industry. And one of the most striking examples, if we are referring to the figures provided by Morningstar, is that 1,500 Article 9 funds in Europe could lose their status, for example. So a lot of Article 9 funds are considering reclassifying as Article 8, which has more flexibility and less chance of incurring regulatory action. By the way, you can still have a very ambitious fund within Article 8, and Article 8 is maybe more comfortable. But the key message is that this reclassification of funds from Article 9 to 8 are mostly a result of ongoing regulatory guidance from the European Commission, from the national regulators, which has provided more clarity over the time. And as firms align themselves with updated rule set, this is a positive development for the industry.
Thanks for that, Florent. Ross, turning to you. So we talked about a number of different sort of products on the debt side that are coming available. I was wondering about something that's called social bonds. Can you explain to us a little bit about what those are and whether you've used them? Is there much of a market for that, or are they just too specific? Too
sure. Thanks, Adrian. So social bonds are a use of proceeds instrument, and just to mention that there is also a social loan market that's beginning to develop as well. But social bonds are a use of proceeds instruments which effectively seeks to address social issues affecting society, such as poverty, affordable housing, access to education and healthcare, etc. And they are becoming, an increasingly important and relevant instrument in the sustainable finance markets. I think in terms of total issuance to date, so social bonds and their, I suppose, related cousin sustainability bonds each account for approximately 10% of total issuance to date. Sustainability bonds are, again, a use of proceeds instrument, but one that combines both social and environmental objectives. So maybe funding, for example, social projects, for example, building hospitals or schools, and also environmental projects such as renewable energy, as an example. I think the market and the issuance of social bonds in particular spiked considerably in the aftermath of COVID, as various national and quasi-national issuers responded to the crisis with raising instruments that could help to address the challenges, the social challenges caused by COVID. I absolutely do think that there is a market for these instruments, and I think I guess the sustainable finance market probably has its origins more, closely focused on the environmental objectives of ESG. But I think we're increasingly seeing more and more interest and scrutiny around social objectives, and issuers and borrowers are, defining a wider ESG strategy, which is, not just focused on environmental issues. HSBC has been very active in the space, and for example, in September, just give you two recent issuances, which we're a joint book runner on. One is Spain state-owned financial agency, ICO, where we helped arrange a 500 million 5-year social bond, with the proceeds there going for socially beneficial projects such as affordable housing, healthcare, education. And another issuance was for a French development agency called AFD, again in September of this year, where we were joint book runner on 1.25 billion 5-year issuance, with the proceeds in that case as a sustainability bond being a mixture of social projects and environmental projects. Now, I think the space for instruments that address wider societal objectives is only going to grow, and I think these kind of product developments are welcome and are needed and are being embraced by issuers and investors alike. So, you can certainly see the issuance volumes for these products increasing over time and generally gaining sort of share again in the wider sort of sustainable finance complex.
Good to hear. Very interesting. Thanks, Ross. Denise, turning back to you. Can you talk to me about, you mentioned before that, perhaps where you sit in sort of financial services is not the most obvious linkage in the chain sometimes when we're talking about ESG or when we're talking about sustainability. But what are the biggest challenges, Liberty faces in integrating these kinds of considerations across its products, and how have you worked on that?
It's a great question. And I think what struck me is really in our industry, what can really still be repurposed or applied or kind of lines that can be brought to different challenges. And that's something that we're going to need to continue to work at. And we certainly haven't exhausted all of that potential, particularly just in terms of straight insurance products. And that might be making, multi-line kind of offers, or making longer term arrangements or agreements with clients, because many insurance policies kind of work on a 12-month policy basis, and we're often dealing with longer term challenges like transitions that we know certainly aren't going to be held to any kind of 12-month kind of cycle. So I say there is something in there that we need certainly to work through. And then there's the fact that there are certainly lots of new and exciting tools, technology, innovation, and startups that we work with and amongst us. One of those, for instance, very practical real-time flood warning technology that can be so valuable, and how we integrate that into our services. For instance, we have something called Liberty Risk Reduce, which helps analyze policyholders' individual risk and offers additional kind of resources to mitigate that. So how do we bring some of those exciting new features into, say, existing products or support? On the more kind of innovative side, something that we launched in recent years is called a reputational crisis product. And that's actually using artificial intelligence to monitor kind of media chatter to help companies actually get ahead of or actually mitigate reputational damage. So there's all kinds of, I think, practical challenges in here, and some of those considerations, as well as kind of some of the bigger picture. I think product aside, there's also the dimension of advisory. So is it that perhaps more risk engineering, more advisory consulting services would better make our clients more resilient, in addition to the more traditional, if you like, products? I mentioned Liberty Risk Reduce, but also, for example, in North America, our global risk solutions team there is offering complimentary access to certain ESG risk advisory services for sustainability and climate-related risks and opportunities, particularly in the American and Canadian markets, and if they opt into an ESG risk rating that Marsh has developed, obviously as a broker. So there's a lot of there's a lot of new ideas in this space, a lot of opportunities that we could reactively get involved in with the market, and then of course drive through our own products and services. So I think there's kind of it's a lot of, we see it as more opportunity than challenge, perhaps, per se, and just being able to I think assess that and figure out what works for us in the market, and what we of course want to put out there.
Thanks very much, Denise. Florent, turning back to you, we're coming into the last few minutes of our panel, but I think that this is important. We talked a lot about SFDR, which has been so key for fund managers in Europe. How does it fit with the EU's green taxonomy, though, which came out recently as well, and sort of helps to define different categorizations for what kinds of products and what kinds of projects fit where in the sustainability spectrum? Can you talk to us about that a little bit?
At this stage, it is not a good marriage. Currently, there are two frameworks to define a certain notion of sustainability: SFDR and the taxonomy. On the first side, on SFDR, there is a need to clarify the definition of sustainable investment, which currently leads to complications because there is no clear way of identifying and calculating which company qualifies as a sustainable investment, leading to a lack of comparability due to diverging interpretation. At Amundi, we consider there is a very high risk of confusion and discrediting of the asset management industry due to the fact that not only each asset management company will operate diverse methodology, but more than that, the results in terms of sustainable investment percentage for each significant financial indices is potentially extremely heterogeneous for same financial exposure or for the same financial products. Hope we will receive rapidly clarifications from the European Commission in the coming weeks or months in order to fix rules and to incite to a market convergence on sustainable investment to end with the confusion and just we would need to be given sufficient time to implement. On the second side, on taxonomy, taxonomy framework produces very low percentage taxonomy result. The taxonomy framework is a very powerful but depicts the situation of a company as of today. And as of today, the economy is not green at all, nor sustainable. And one of the most striking example is that equity indices in developing markets show taxonomy alignment about 5-6%, with very high discrepancy from one sector to another. So at this stage, the clients cannot really use taxonomy information. Hopefully, data quality and coverage will increase over time, and we are convinced at Amundi that we could set more ambitious taxonomy targets when the quality of taxonomy estimates will improve, notably thanks to the first corporate reporting standards.
Thanks very much for that, Florent. And a final question, which I'm going to put to Ross to wrap up our panel, in which we turn inwards, which is, about, we've talked a lot about sort of creating sustainable products for clients, creating, sustainable opportunities out in the world. But what about organizations themselves? So I wondered if you could talk a bit about the challenges that banks face as they seek to align themselves with net zero targets. And how some of these sustainability-linked instruments that you've talked about can perhaps help with achieving that objective.
Sure. Thanks, Adrian. I guess when we think about emissions, I guess most people are familiar now with the concept of scope 1, 2, and 3 emissions. And taking my own institution, HSBC, as an example, we've committed to have our own scope 1 and 2 emissions at net zero by 2030. And that's the relatively easier part of the puzzle to solve. It's more within our control. I think the more difficult part for HSBC and for most banks is when we think about our scope 3 emissions, which is by far and away driven by our financed emissions. And HSBC has set out a target to align our financed emissions to net zero by 2050. And this really is a very big challenge and a very complex undertaking. Earlier this year, we set out targets and we published our finance emissions for 2 energy-intensive sectors, being power and utilities and oil and gas. And we've also published our plan of how we intend to reduce our financed emissions from those 2 sectors, targeting 34% absolute reduction in financed emissions for oil and gas, and a 75% reduction in financed emission intensity from power and utilities by 2030. We plan to publish further targets for other sectors during 2023. But the real challenge is around the data and the availability of the data and the accuracy of the data. And I think some of the largest global companies in the world, are really beginning to make good progress in this space, and they're hiring teams and they're employing technology and consultants to come up with pretty good numbers and pretty accurate estimates of their emissions today and their trajectory going forward. But there's a whole host of companies that are in this sort of mid to smaller size that just don't have the either technical know-how or the financial resources and are busy just struggling every day in the current challenging environment with inflation and all the other issues that the economy faces today. So it's a huge undertaking, and I think it's the real hub of the challenge is around data and the availability of good data. We have set out our strategy to be partner with our clients on their transition journey, and there's a big exercise underway where we're looking to understand our clients' transition plans and how we can help them on that journey. But it's a big and complex challenge, and there are various ways we can get to net zero and various pathways, and understanding the current emission profile is challenging enough, let alone understanding the emission trajectory when you're projecting out many years into the future. So, but there are some great minds that, thrown at this problem right now as we speak, and not just in HSBC, but across various financial institutions. So I think that's probably the biggest challenge facing the banks, the global banks today, as they look to deal with their Scope 3 emissions, which are, effectively our financed emissions.
Thank you very much, Ross. Well, I think that that's a good note for us to end on. What I'm hearing is a lot of innovation, interesting ideas, new products coming to market, but these are extremely big and complex problems, and ones that do affect us all. But on that note, I want to thank my panelists for sharing their thoughts and their experiences, and I will send this back to Judith. Thank you all for listening.
Thank you, Adrienne Clauser, and her fantastic panel speakers, Denise, Delaney, Ross Keeling, and Florent Deixonne. Now, we want to shift it a bit in another direction now into one of the subcategories of sustainable financing, and that is carbon financing and emission allowances that put a price on those CO2 emissions. Now, yesterday, at the end of day one, it was Genuino Christino, CFO of ArcelorMittal, who touched upon that market and explained how important this carbon market is to finance the transition in one of those hard-to-abate sectors, the steel sector he's working in. And indeed, the EU carbon market has been growing significantly since 2005. And so its reform is one of the cornerstones of the EU's Fit for 55 package that aims to make the Green Deal more effective. And to give us the perspective of the securities regulator on carbon markets, I have the pleasure to welcome our next guest, Verena Ross, to the Sustainable Finance Forum. She's the chair of the European Securities and Markets Authority, ESMA, since November last year. Before being appointed as chair, Verena served as ESMA's first executive director since 2011 and was responsible for building up the organization and overseeing its day-to-day business. A warm welcome, Verena, and over to you.
Thank you very much, Judith. Ladies and gentlemen, I'm delighted to be able to speak to you today at the Sustainable Finance Forum. Sorry, not in person and only remotely, but it is a great honor to contribute to the discussion in this important forum on the role of sustainable finance in combating global warming. I will be speaking to you today about the role of carbon markets on this path to net zero, and particularly, as the chair of ESMA, I'm speaking from the perspective of securities regulators. The landmark report on climate change from earlier this year by the UN's Intergovernmental Panel on Climate Change highlighted the effective action that will be required and that we still need a lot of investment. All countries are falling way short in their efforts, with financial contributions being 3 to 6 times lower than levels needed by 2030, and even starker differences in some regions of the world. Carbon markets can facilitate this financing effort. A true price on carbon is critical to create the right incentives to reduce CO2 emissions. By enabling companies to pay for the carbon they emit, they incentivize them to switch to cleaner energy sources. Moreover, carbon markets act as an important mechanism to then channel those funds to vital emission reduction, avoidance, and removal projects, such as renewable energy, reforestation, or carbon removal technologies. Therefore, as the drive to tackle climate change gathers pace, carbon markets have become increasingly fundamental to achieving net zero greenhouse gas emissions. To begin with, it is important to distinguish between two main types of carbon markets. On the one hand, you have compliance carbon markets that are markets established by laws or regulation at national, regional, or international level, whereby a limited supply of emission permits or allowances are either auctioned or freely distributed to firms that are mandated to participate. This part is known as the primary market. Depending on the needs of those firms and levels of usage of those credits, subsequent trading of those emission allowances may take place on the secondary market. As I will explain shortly, it is principally in the secondary markets where financial firms have begun to play an increasingly important role. Just to give you an idea of the overall size, turnover of compliance markets globally in 2021 was 760 billion euro. That's an increase of 164% from 2020, so a huge growth. On the other hand, the second type of market that exists are voluntary carbon markets. They are not tied to mandatory schemes or regulatory requirements. In this market, any company or individual can purchase carbon credits to offset their own carbon footprint voluntarily. These markets remain relatively small compared to the compliance markets, but demand is growing rapidly as companies worldwide want to realize their own ambitions of net zero. Today, I will mostly focus on compliance carbon markets, so the first type of market I talked about. And in particular, given the nature of today's conference and considering ESMA's own experience to date, I will focus on the EU's carbon market, which is known as the EU Emissions Trading Scheme, or ETS. Let me start with a few facts and a bit of history. The EU launched the first compliance market in 2005. Accounting for 90% of the global value of compliance markets, at currently about 680 billion euro, the EU ETS remains the world's biggest and most liquid carbon market today. It is known as a cap and trade system, which limits emissions from approximately 10,000 energy-intensive businesses and around 500 airlines, covering altogether just over 40% of the EU's greenhouse gas emissions. The EU ETS functions at two distinct levels, a primary market and a secondary market. In the primary market, EU allowances, or EUAs, are either allocated for free or auctioned to regulated firms who need to comply with emission limits. Subsequently, depending on the anticipated emissions levels of those firms, they may decide to buy more EU allowances if they are expected to exceed their emission limits, or sell allowances if they expect to fall below those limits. This trading takes place on the secondary market, which is also where a number of other players enter the market, such as financial entities. The allowances are traded as either spot contracts or derivatives. This means that they fall within the scope of EU securities regulation, including with regards to regulations covering areas such as market abuse and money laundering. It is for this reason that the role of EU securities regulators has expanded over time, and also why ESMA has begun to play a role, which I will mention and explain a bit more shortly. Before doing so, it is important to recognize, as Judith already said, that there are policy developments at the moment in relation to the EU ETS. This results from the Commission's Fit for 55 package, which was launched in 2021 and which aims to achieve the bloc's new climate target of minus 55% emissions by 2030. In order to align the EU ETS with this new goal, reform of the EU ETS directive is now underway. The European Commission has proposed a number of changes to strengthen the EU ETS market and further reduce the emissions in the sectors covered by it. Let me now move to what we as ESMA have been doing in this area. We saw in 2021 an exceptional rise in global energy prices and market volatility, which obviously has been even further accelerated this year. On the back of this, the European Commission asked ESMA to enhance its monitoring of EU ETS market developments, including trading behavior and to consider the need for possible targeted actions. Our final report that was published in March this year presented an in-depth analysis of the trading of EU allowances and related derivatives contracts. Based on data gathered from various sources, we looked closely at prices and volatility of EU allowances and the evolution of trading structures and counterparties. We looked at all of this from about 2018 onwards. Regarding the price evolution of EU allowances, while prices have increased tenfold between January 2018 and February 2022, we observed that this has followed market fundamentals, with clearly identifiable price drivers. The same holds true for volatility in the market, which has remained broadly stable over this about 4-year time period, apart from some short-term volatile incidents, for example, most recently at the outset of the Russian war in Ukraine. In relation to trading of emissions allowances and the type of counterparties in this market, we found that the various segments of the EU carbon market appear to broadly function as expected. Most of the trading in the secondary markets takes place through derivatives contracts, where compliance entities buy EU allowance futures to hedge their carbon price exposure, while financial counterparties act as intermediaries to facilitate trading and provide liquidity to the market on the short side. One important aspect to highlight is in relation to the role of investment funds in the EU ETS. Funds at one point have been blamed by some of the public debate for being main drivers of price hikes last year. However, our work found no evidence to suggest this was necessarily true. In fact, the positions held by funds remained limited. And while it is true that the number of funds active in the EU ETS has grown, this growth has not been faster than for other categories of counterparties in the market. We are conscious that as part of the debate on the ongoing reform of the EU ETS directive, it is being considered whether to limit the participation of financial firms in the market, due to a sense that speculative activity on their part has had a negative effect. However, I have to say ESMA has not found any evidence to support limiting the participation in these markets only to non-financial counterparties. On the contrary, we see financial entities providing liquidity and facilitating the access to these markets for entities with compliance obligations. They do this by disseminating EU allowances on the secondary markets. Financial firms act as counterparty to compliance entities who wish to purchase futures for hedging purposes, and thereby limiting those entities' immediate capital outflows. Finally, financial firms play a similar role in the EU ETS as in any financial market, acting as market makers, as brokers, and clearing members. In our view, these roles improve the functioning of the market overall. Our work did not unearth any major abnormality or fundamental issue in the functioning of the EU carbon markets from a financial supervisory perspective. At the same time, we also put forward a series of policy recommendations which we believe should contribute to improving the transparency and the monitoring of the EU ETS. We believe that the measures proposed on reporting would provide more information to market participants and the public at large about the carbon market, and they would help in maintaining orderly markets going forward. Ultimately, such measures would therefore contribute, we believe, to the continued adequate functioning of the EU carbon market. We are looking forward to seeing some of those proposals being taken forward by co-legislators as they progress with the challenging task of reforming the EU ETS. Before I conclude, I would finally like to broaden my remarks to highlight some of the work of securities regulators that is happening at the international level. This year, I had the pleasure to chair, together with the chairman of the Commodities Futures Trading Commission in the US, Russ Benham, a group of IOSCO that is basically bringing securities markets supervisors together to look at carbon markets. IOSCO members felt that, given the growing significance of these markets globally, and the expanding role of securities regulators in this context, it was important to look more closely into the functioning and potential risk and vulnerabilities in these markets. As I already explained, there are two types of carbon markets, compliance and voluntary. While they broadly aim to deliver on the same goals, they're very different in how they do so. IOSCO has therefore looked separately at each type of these carbon markets. For compliance markets, much like the work that I just explained that ESMA has done on the EU ETS market, our work here at global level has focused on the different regulatory frameworks that exist around the world, how the markets are structured, and who participates in them. At the global level, we aim to put forward recommendations to support the further development of these markets based on good practices and the relevant experience that some securities regulators have already gathered. For voluntary markets, while they're currently much smaller, they're expected to continue growing rapidly in the coming years, with some estimating that the market, which was valued at just about $1 billion in 2021, may reach $50 billion by 2030. Of course, voluntary markets have also faced challenges in their efforts to grow and have been plagued by questions concerning the credibility and integrity of carbon offset credits. Just recently, even the British-American comedian John Oliver took aim at these markets in his well-known satirical TV show in the US, where he criticized the credibility of these schemes and pointed to the use of low-quality offsets in greenwashing by corporations. These criticisms are fair, and they have thus galvanized key stakeholders to band together to address the existing deficiencies in voluntary carbon markets and look at building trust in them. These efforts were jump-started last year when a blueprint on creating a large-scale, transparent voluntary carbon market was published by the Task Force on Scaling Voluntary Carbon Markets under the leadership of the former Bank of England Governor Mark Carney. Efforts have since been taken forward further by other bodies, such as the Voluntary Carbon Market Integrity Initiative and Integrity Council for Voluntary Carbon Markets, who are working to establish common criteria for assessing carbon offset projects, as well as guidelines for buyers of these offset credits. We see the work of IOSCO on voluntary carbon markets as complementary to these initiatives. Despite these markets not falling directly into the remit of securities regulators, we aim to put forward considerations which can support better quality, integrity, and transparency in voluntary carbon markets. I encourage all of you who are interested in this work to keep an eye out for these upcoming reports, which IOSCO hopes to publish in early November. In conclusion, we live clearly in very volatile times right now, and carbon markets have not been immune to the geopolitical and macroeconomic forces that are creating the current uncertainty. We must not lose sight of the long-term outlook for carbon markets and the fact that they can provide an important contribution towards net zero. We must therefore support the continued development of these markets by ensuring that they are held to high standards of integrity and transparency. In doing so, carbon markets can play a key role in helping accelerate the green transition by effectively putting a price on pollution and creating an economic incentive for reducing emissions. ESMA and national authorities will continue to play our part in monitoring market trends and trading behaviors of participants in the EU's carbon market in order to ensure the continued smooth functioning of these important markets for the EU's transition to a low-carbon economy. Of course, much like today's agenda of the Financial Finance Forum, where a multitude of critical issues on the sustainable finance agenda are being debated, carbon markets are also just one element of ESMA's work in the area of sustainable finance. We've outlined in our Sustainable Finance Roadmap that we focus on a broad range of areas that aim, on the one hand, to promote transparency and tackle greenwashing, secondly, monitor and assess ESG markets and risks, and finally, and by no means least, build knowledge and capacity, both at ESMA and with our member authorities. Through our work on carbon markets and beyond, we are committed to playing our part in advancing the critically important sustainable finance agenda in the years to come. Thank you very much for this opportunity to speak to you, and have a good rest of the conference.
Thank you very much, Verena Ross, there, Chair of the European Securities and Markets Authority. And who would have thought that regulators are listening to comedians like John Oliver? There you have it. Now, staying with the theme of regulation, yesterday we heard, of course, from Claude Marx, the head of the Luxembourg regulator in the financial industry, what's next on the EU's regulatory agenda. He mentioned, for example, the RTS for SFDR, the regulatory technical standards that are coming in from the beginning of next year. One of the pieces he didn't mention that I know is in the pipeline is a potential pan-European eco-label. Of course, labeling has been for many years already in the market and playing a pivotal role to provide transparency and trust in sustainable investing. And that, of course, goes back to the other issue that he mentioned, that was mentioned through many discussions yesterday and today, and that is greenwashing. And that will remain, of course, a vital topic as this regulatory landscape is being developed. But let's look more closely at what's next for labeling specifically. And for that, I have the pleasure to welcome two experts who work for well-established labeling firms that have been setting a very high bar for those sustainability criteria and adhering to them. And one is Isabelle Delas, CEO of LuxFLAG. She came to LuxFLAG just in May this year, after serving as head of the Luxembourg branch of the impact asset manager Finance in Motion. And from the Nordics, we have Per Sandell, head of sustainable financial services at Nordic Swan Eco-Labeling. He has been with Nordic Swan since 2005 and is in charge of Nordic Swan Eco-Label for funds. Warm welcome to both of you. So warm welcome to you, Isabelle. Great to have some company in the studio here, and warm welcome also to Per Sandell, who's joining us digitally. So I find it remarkable to have you both together after we've been talking over the course of this event so much about preventing greenwashing and the need for good data and transparency and integrity. So LuxFLAG and Nordic Swan Ecolabel, from my perspective, have been setting a high bar because both firms are really well established in the sustainable finance space. Just for our audience, LuxFLAG was launched in 2006 as a non-profit agency between 7 public and private partners, and that includes also the government of Luxembourg. And Nordic Swan was already established in 1989 and features as the official eco-label of the Nordics, as it were. So my first question goes pretty much to both of you, and if I may start with you, Isabelle. Could you give us a perspective of your mandate in 2022? Where is the labeling business at?
Thank you, Judith. I'm very pleased to be part of this panel together with Pierre. Well, for LuxFLAG, we prefer to speak about our mandate rather than a business, basically. For our mandate is to move forward the sustainable finance journey to the financial industry sector. And we basically focus on labeling investment, insurance, and as of now, private mandate labels, but not the managers of such labels. So our labels focus on 2 main aspects, basically. We have impact and sustainability transitions label. Each of those labels has its own criteria and some similarities, of course, depending on the nature of the label, because 5 are dedicated to funds. For us, we consider that the LuxFLAG label is a strong signal that a financial product such as an investment fund, an insurance product, and now again a private mandate product meets LuxFLAG criteria and exclusion policy. In a nutshell, LuxFLAG mission is really twofold. On one hand, we accompany applicant financial products in their sustainability journey. This is done mainly through the sustainability transition label, the ESG insurance product, the ESG discretionary mandate product. And on the other hand, LuxFLAG promotes transparency by recognizing the champions in the market and rewarding them through the LuxFLAG 4 impact labels. So we have the historical label on microfinance, the environment, climate finance, and green bond labels. And these impact labels are dedicated solely to investment products which can provide high sustainability standards by investing in given asset classes. Currently, LuxFLAG has labeled 350 products, with investment products reaching almost 188 billion of assets under management, which are being distributed internationally in more than 70 countries.
Okay, let's turn it over now to Per. Per, same question to you. Where does labeling at Nordic Swan stand in 2022?
Well, as the official third-party label, we are, of course, constantly raising the bar. So currently, we are in a very interesting phase where all the 75 funds that we have labeled, we are checking that they can live up to our new stricter criteria that we launched a few months ago. And those criteria are, of course, in all of the areas of exclusion, inclusion, transparency, and of course also active ownership. And that shall be seen in the light of a very healthy discussion on greenwashing, as you know, that has also come to the financial industry. Here I know that labels such as the Nordic Swan can play a very important role as a third-party verifier that product reach very high thresholds and has robust systems in place.
Can we dig a little bit more deeply, starting with you, Per, in regards to the changes we've been seeing in the financial industry and all that regulation that is now being built? I said earlier, the sustainable finance architecture that is a work in progress, if you will, and the market has been responding to that. Over the course of this event, there was some gentle criticism about the sequencing that could have been done better. So how does that land at your end? What is happening in the markets here?
Well, we see a bunch of trends. A lot of things is happening. There's a lot of discussion when it comes to net zero, transition, and of course the definitions of sustainable investment. But what I find very interesting is the growth in the discussion about biodiversity that has grown over the last year, where asset manager is sort of starting to act more frequently, where the data providers are tweaking their offerings, and I'm really glad that the project of the Task Force on Nature-related Financial Disclosures are really start to get going. And I'm saying that because we currently have a really big loss of biodiversity across the globe. So I hope that the financial industry can now take the role and sort of lowering the pace where we lost biodiversity.
So biodiversity as one of the themes where the financial sector is taking action in many ways voluntarily, although frameworks are likely to come. As I was saying yesterday on the event that the G7 are going to focus on this much more due to the reasons you mentioned. Are there other themes that are becoming more important for the financial sector in regards to labeling?
I would say the always ongoing discussion when it comes to transition criteria is always part of what we are discussing often with asset managers, and where some always want to go for the very best already green funds, and other wants to go for the sort of the transition and sort of give the correct information to the retail investors are a really key thing there. So educating retail investors would hopefully be the next coming big thing.
Interesting. That was already mentioned in the panel yesterday by one of your Nordic colleagues from SEB, Christopher Flensburg. Isabelle, from the perspective of LuxFLAG, which changes and trends are you seeing as this transformation, sustainability of transformation is underway in the sector?
I believe everyone has already talked about the education and the lack of data, of reliable data, I assume. I would like to see that more on a positive side, basically, because with the upcoming entry into force of the regulatory technical standards, the RTS, basically we expect to get more data and more standardized documentation, which will support that sustainable transition. And this is a trend, of course, that we are following, which is also affecting LuxFLAG internal processes, just because we have to adapt our labeling review process. What I see very much as a trend, and I'm also quite happy about it, like also Pierre mentioned regarding the biodiversity, but I think now the focus will be probably in the future about VS, that everyone seems to question, and thinks that there is no enough sufficient standards or benchmarks available, but this is something which has been addressed, quite in the past, and I'm quite sure, I'm quite keen that then that will be the next hot topic for the upcoming future.
Of course. Would you agree there, Pierre, that the S in ESG is also one of the themes that needs more attention?
I would say that both E, S, and G needs more attention. It's been discussing over the last year that the S needs more attention, and of course I agree with that, but I would go for all of the E, S, and G.
Okay, all right. Let's move it forward a bit. So how are labels, starting with you, Isabelle, how are labels adapting in this emerging architecture? Because they're, as I mentioned earlier, the sequencing of the regulation coming in is not always probably, it's a work in progress. Let's go back to that description with the SFRD and the taxonomy coming in at different times. How has that been impacting your work?
Basically, of course, we have been around for the last 15 years.
Of course.
But we had to update and to align our eligibility criteria with the EU regulation, with SFDR, all standards and all documents that are requested, of course, because we are reviewing the application packages of, for example, asset manager that have to comply for sure to those regulations. And secondly, we have created new labels to also involve other participants from the financial sector. So the banks, for example, with a recently launched ESG discretionary mandate label. And also last year, it was launched a ESG insurance product for insurance companies, with also that's a momentum for them to get also to comply with those regulations. So, and out of that, we are really accompany them also in their compliance journey.
And for you, Per, for your work at Nordic Swan, if I just may reference here some of the heated debates we've been seeing, especially around the taxonomy, as we know, in the European space, was the inclusion of gas and nuclear. And in other aspects, how has that impacted labeling work at your end?
Well, we stick to the exclusion of natural gas and nuclear at the Nordic Swan. It's you can throw as much politics on those as you wish, but it still will not be sustainable. So from our perspective, we will keep the exclusion of that. But I also have to say that we at the Nordic Swan also have our transition criteria for natural gas and uranium and so on. So if a company has over 90% of their capex in the renewable area at the same time as at least 50% of their revenue is in renewable energy, such a company can be in a Nordic Swan eco-labeled portfolio. and data we have seen that those criteria sorts out about 5 or 10 companies in the world. So fairly strict transitions and criteria. But if you allow me, I would like to sort of mention a few things on the sort of SFDR taxonomy landscape. I think it's very sort of important to keep in mind that not so much of all of the economic activities are eligible in the taxonomy. So I think that labels can play a very important role to sort of helping asset manager to do a lot of great sustainability work outside the taxonomy as well. So that's a very good thing that label can be helpful for the work to be done.
Thank you very much, Per, for raising that issue. Absolutely. I would like to bring in the aspect of a potential pan-European eco-label that is in the pipeline. Could you give us some perspective, Per, what the expectations might be for such a pan-European eco-label?
Setting such a label is a really fine act of balance when, of course, the retail investors often has very high expectations, but at the same time, if we look into companies, not so many of them can sort of reach that expectations. In the draft we've seen so far on the EU Eco label, a 50% threshold is set for taxonomy alignment, and I think that will be a very, very, very tough threshold to meet. So and not expecting so many funds to get past that. And if the Commission is sort of seeking to make an impact with the pan-European label as the EU label, I'm not expecting so much impact to happen due to very few funds can pass such a threshold.
Thank you. Any thoughts from you, Isabelle, on a potential pan-European eco-label?
I think it will be very hard, I believe, to harmonize criteria for all European countries, and basically and to be applicable for all EU labeling agencies. Currently, there are 7, if I'm not mistaken, labeling agencies, which we have whole different offers in terms of labels and in terms of products to be labeled. So for us, of course, we are ready to be recognized also as an EU eco-label agency. But for the moment, I think exactly as agreed with Pierre, that it will be very difficult to meet those standards.
So I'm sure there's... Yes, please, Per.
Yes. And an even more interesting thing would be that if I understand it correctly, the EU label is seeking to sort of set up criteria for the taxonomy and using that taxonomy. And now when natural gas and nuclear is part of that taxonomy, those funds that are sort of wanted to get labeled, I would assume that the target group of those funds perhaps don't think natural gas and nuclear are sort of green. So it's a potential clash there between sort of the target group of the label and sort of using the taxonomy. So it will be interesting to see how it turns out.
Very much so. That inclusion has thrown a bit of a piece of wood in the functioning, maybe, or in the total agreement of the European community and how that could work out. So work in progress. We keep going back to that. Let's look ahead. How do you see? Let's cast our eyes 10 years forward, Isabelle. How do you see the financial sector? As the financial sector evolves to the new realities, say 2030, we make it to meet our climate goals. Where does labeling stand then?
I think labeling are very important, and they are the only unique tool and unique signal, basically, for investors, and in particular maybe retail investors, to get a sort of guarantee that an investment process, and that all is in place, from the prospectus to all the documents, exclusion policy, whatever documentation we request, basically, that this has been properly screened and is under ESG process perspective, and that's something that's reliable and for them to make sure that they are investing really in the right products.
So again, that role of
an additional layer, basically.
Yeah, the role of building trust,
yes,
and integrity. Yeah. Per, what's your perspective? 10 years down the road, we've made it to 2030 with. I'm being very hopeful now. Not everyone is of that mindset. We've met our goals, or we come close to it. What's the future for labeling at that point?
Well, I are often a lot of optimistic myself, but I would guess at 2030 there are still a lot of work to be done, and of course I think labeling will play an important role in even in 5 or 10 years, and I say that in perspective of the SFDR that are now evolving, which is more of a self-declaration thing than a third-party verifying function. So, and I would assume that not only investors, either retail or professional investors, will be sort of seeking the help of a third-party labeling scheme, but also perhaps other stakeholders.
Excellent. Thank you so much. Our time's up. Thank you very much, Isabelle Delaney with me in the studio, and Per Sandell joining us digitally. And now, for our final highlight of this 2022 Sustainable Finance Forum, I have the pleasure to introduce a true expert, from my perspective, one of the most knowledgeable people in the financial services community in regards to sustainable finance. And he's Sasja Beslik. His backstory is also quite inspiring, because as a refugee from the war in Bosnia, he found a home in Sweden by almost sheer accident, and built a very successful career around how to invest responsibly, including many years of service at Nordea Wealth Management, where he launched the so-called the STARS Fund back in 2011, so that's quite a while ago, that helped to pioneer sustainable investment across Europe. And for his work in the field of finance and sustainability, he was awarded the Royal Order of the Seraphim by the King of Sweden. And last year, he wrote a book about his expertise, which he called, with a co-writer, Where the Money Tree Grows, How to Invest Climate Smart and Get Rich. This year, he went to Japan from May onwards to serve as Chief Investment Strategy Officer at SDG Impact Japan. And now he's with us. Welcome, Sasja, and over to you.
Thank you very much for the invitation to this event, and I hope that all of you have had a great day so far. And I'll try to elaborate a bit about the importance of ESG where we are today, but also what is going to happen for the next coming years in this space. If you look at the background and the past on ESG developments over the last 5 years, what you can see is clearly that ESG is in its form as the part of the asset management industry's way of looking at broadening the spectrum of understanding the risks and opportunities of its investments, has become almost like an integrated natural part of asset management industry. However, looking at the prospect of ESG going forward, there are a number of course, challenges and opportunities in this space. Looking at the past couple of years, we could also see that the very big development, or the volume of development in the ESG space, has also led to the fact that authorities around the world have started looking at the industry of ESG and understanding that the importance is going to grow, and also the importance of regulations will grow. So in that light, we have had development of SFDR, Sustainable Financial Disclosure Regulations, along the line of EU taxonomy. These two elements are, of course, shaping how the asset management industry in Europe is viewing ESG, but it's also pushing other parts of the world, Asia, Japan, and US, to sort of align the regulation context and the framework of regulation with the European Union. If you're looking at what ESG is all about, I think we need to sort of start with that question. What is ESG about? And I think the answer to that question is its intent to broaden the understanding of impact corporates have on the environment, people, and also the way how these corporates, in a way, shape societies they operate in. As such, as intention, it can be interpreted and implemented in various ways, and different asset managers and asset owners are viewing this in a different light. But I think what is important to stress that ESG is unique in so many ways. It's a historical approach to investing because it's the first time ever in the history that externalities caused by companies and caused by our investments in asset management and asset owner industry are accounted for and measured and reported on, which is something that was almost unthinkable 20 years ago. Geopolitical context of ESG is pretty much about understanding what we have seen happening in Ukraine after the Russian aggression, but also understanding what is going to happen forward in many other markets where some of these developments may cause, I would say, not only withdrawal of investments, but also a lot of questions around these investments in terms of what they are really contributing to. The latest criticism on ESG, which is in many ways really correct, and correct from this point. So far, the ESG as the approach and attempt to broaden the scope of investments has been focusing on process, information in terms of the data gathering, data transfer into the investment management processes and so on, but it has not been related or actually focused on creating results. The world we live in and the challenges we are facing, including the climate change, but also growing socioeconomic disparity across the world, amplified by energy crisis in Europe and amplified in many ways by things that will happen in other parts of the world from socioeconomic point of view, will push ESG in the investment context, but also I think world in general, towards more focus on results and more focus on what are the real and tangible outcomes of these investments going forward. The part of the criticism is related to the fact that I read it just recently, that what is ESG actually creating? And that's a very important question that we can ask ourselves working in this space. And that question is also related to the fact that we have failed in many ways to actually address what these investments are contributing to and what are the tangible results of all the efforts that have been made. If you're looking at the context of different types of frameworks around the world who are supporting the implementation and integration of ESG into investment sort of a community, you can see that the amount of people and asset managers and asset owners across the world signing on to UNPRI has quadrupled the last couple of years. However, if you look at the emissions of the corporates and companies on the listed equity side, we are investing, and you can also see that these emissions are increasing. So there is a disconnect between what we sign on to and what we are working with in terms of implementing ESG, and also what are the sort of a clear outcomes and results. So ESG is not exclusion exercise. ESG is not integration exercise for the sake of integrating various sort of elements and criteria into your investment management process. The ESG is about changing your underlying view about the role your investments are making in the societies we actually live in. And with that comes the responsibility, not only opportunity, but also responsibility to address some of these risks. If you're looking at the lessons learned from the past, I would say a year and a half, including the Russia and Ukraine, you can clearly understand that from geopolitical point of view, because ESG is addressing the corporate performance in this space, has not really been sort of properly applied in that context. So after the invasion of Ukraine, which took place 2014, We have increased our investments in Russian Federation and major companies listed on the Russian stock exchange by 4 times. Many of the funds operating in Russian context after the 2014 have been branded and sold as Article 9 funds. Many of the largest Russian corporations that are part of these investments are in a way on the governance side very much controlled by Russian Federation and Russian government. Something that the industry has learned a lot about during the past year, but I think it's also pointing and leaving us to think and also judge and assess what are the other potential geopolitical things that we need to take into account going forward, including in this way China with a huge market, and we all know that China stands for 30% of the world index, and many of the companies are leading in many ways in technological transition, including solar and wind, but also other technologies, semiconductors and so on. But at the same time, we are also facing the challenge of governance in many of these companies, but also challenge in relation to a lot of minorities on the social and human rights side, which are in many ways forced to work in many of the areas in China, especially some provinces, where we have supply chains, where we have companies that are producing extremely important products for our transition. So that's one angle. And I think going forward, you will most likely see many managers, many asset managers, but also asset owners asking themselves the question, especially in relation to China, what is the ESG approach we're going to have? Is that based on engagement? Is it based on exclusion? Is it based on some kind of the blind, or I would call it almost like a limited view on some of the risks that are related to investments in that way? On the product side, if we're looking at the product in the asset management industry in general, we like new products because the new products enable us to take fees for the products that we are providing to the markets and to the clients. And if you're looking at the offering of the products on the market, ESG market, it's pretty much dull from product perspective. Plain vanilla, global equities, European equities, fixed income products that are pretty bleak in terms of how they are constructed, giving the ingenuity and the capacity the financial industry have. We have been rather shy in developing really creative financial products that will enable that transition, private public, but also on a private listed equity side, where we could do much more in the areas where the transition is really needed. And I'm talking about big parts of Africa, the Asia ex-China and ex-Japan, South America in many ways, very underdeveloped markets from the product perspective, a lot of opportunities in that space, which also indicates that another angle of this, which is growing, the interest in growing in alternative ESG data. Probably when you sitting there today, you know that ESG data has been picked up as one of the key elements for transition in terms of the investments, the need for scope 3 emissions in the reporting from the companies that we will take into our investment models in order to price and value the transformation capacity of the business model and companies. But this is, on the data side, I think one of the biggest challenges, and this is going to be the topic for a big, I think, international discussion going forward, is that all of the data that we have access to today is not verified and certified by third parties, which in principle means that it is self-reported by the companies, transferred into us by agencies like MSCI, Sustainalytics, and RepRisk, and many others, and used as at the fair value in our sort of assessments and data transfer, which is, of course, I think, given what we have learned in Russia, and just going back to Russia, the Sberbank, which is the biggest Russian bank, it was upgraded in December, just before the attack in February, to AAA company, which indicates that the data in itself is actually not really an issue that has been resolved. And I think my take on this is that the data needs will increase, the data, alternative data will increase, we will get more and more data. But in the same time, the asset management industry, and I think also asset owners, are spending less and less time on analyzing the data and putting that data into a context. Given the complexity ESG pose to corporates, but also to asset management and financial industry in a broader context, it demands much more thorough analysis and far more, I think, diligent way of looking at the context where the companies are operating than the analysis that has been done so far. It will increase pressure on the financial industry, and financial authorities will, of course, through the regulations in Europe and other places in the world, increase pressure on reliability of the investments from the client perspective, given that we are talking about huge amounts of assets that have been flowing into this space. So you will see a significant shift, and I think more focus on analysis going forward will give you better results. And what I mean by results, from my experience, I've been doing this for 20 plus years across Europe and investing across the world. The ESG on the performance side has been debated for a number of years. It has been discussed if this is really creating any value on your investment side. My experience as the asset manager, portfolio manager, investment professional is it does, but it depends. It depends where you do it, what segment you're looking at, what industry, what region, what type of instrument we are talking about. But what is the most important thing of all is what kind of a horizon we are talking about. Are we talking about a horizon that is 1 year, or are we talking about investment horizons that are between 3 to 7 years? What I think and what my sort of experience is that the ESG in a context of investments from a performance point of view has the most effect on in a mid-cap segment, preferably on the emerging markets, where regulation is fairly weak, need for the companies to grow big, abilities they have to transform quite good, both from, often from a management perspective, but also from a market perspective. The type of products could be both on a private equity side, on a listed equity side, but looking at the performance of the plain vanilla global sort of products on the market, it's pretty much the same thing across the world, following the major indices, not really deviating too much, creating scale from sort of a data angle, but in principle not giving you what you want. And what you need is the transformation. We need a transformation into something that is far more long-term oriented, that is contributing to change business model, truly change them, not only do it on the surface, but also what we need is the clear and tangible and measurable results. One of the things that is we are struggling with, and we have been struggling with, is that when our clients are asking us, what exactly do I get when I invest in a sustainable investment product or ESG investment product, is that we have been really struggling with explaining, well, this is exactly what your money is contributing to. These are the changes that you have throughout your investments created and contributed to. So far, most of the industry is telling a nice story, often very nice story, about the processes that are used, about the engagements that are done, but in the principle, in a sense, not so much related to really tangible outcomes and results. So that will change. But I think also what one element of the challenges and opportunities in the same way is the wealth management advisory side, and I had quite a good experience in a lot of interactions and experiences, both from a Nordic context and continental European context, and now from an Asian Japanese context, where I'm managing as a chief investment officer Japanese the next gen equity fund, which is just recently been launched. And on the wealth advisor management side, what is interesting is that the level of understanding and the knowledge that people have that are facing and advising clients and customers of the banks, asset managers and asset owners, including the pension side, really are both understaffed, uneducated, and in many ways have big difficulties to understand why exactly are they doing this, and also what difference does it make for our clients. If we're looking in a macro sort of, and I will close with that, the broader sort of a perspective and a broader picture is that we are running into a very, very complex world. We have a very accelerating climate change and global warming across the world. You can see it in Italy, you can see it in Pakistan, in Bangladesh, in many other places around the world. We can see it in big parts of Europe, in the US as well. We have the energy crisis that is partly related to, of course, the war and the Russian aggression of Ukraine, but in the same time related to the fact that we haven't been structurally developing, other sources of energy, including renewable energy, but also to some extent in Europe, there is a big discussion on nuclear, I know. That's the one side of it. The other side of it is that we will, after the COVID restrictions, and now after this, we are facing a big socioeconomic challenges across the different societies in the world. This will push governments and companies to go for the safe havens first. What I mean by that the investments most likely, and the evidence is clear, in fossil industry are increasing. They've doubled last year from 245 billion to 545 billion. 2021, I think that number was going to most likely increase this year even more. And that is pointing to us in terms of, yes, we need to manage the acute crisis right now in relation to energy crunch we have and also the priorities that we've done. But in the same time, we also need to think about how to diversify our supply of structural supply of the energy going forward. And the investments in that space will need to increase. And if you're looking at the amount of the investments into renewable space, wind and solar, I'm talking about only these two, it needs to be 17 times higher every year from now on until 2030. Is it possible? Of course it is. We can do it. But it's also about creating incentive. Going back to the ESG. ESG is not about the greenwashing. It's not about making you feel good. It's not about getting the space in the media so you can proclaim your net zero commitments. It is genuinely about changing the way we operate businesses, including externalities, trying to evaluate, trying to measure them, and also try to get them into the context of what contributions they make for investments for the market economy that we are sort of all operating in. Now, the big question is, given the model we have, which is a growth based with the finite resources we have, how far are we going to stretch the current market economic model from a perspective of growth, and in the same time do that by renewable energy sources, now in Europe gas and nuclear, in other parts of the world, in Africa it's going to be more gas and coal, in US apparently more fossil industry. So there are conflicting elements of this agenda, but I think in the same time, looking forward, looking what ESG is about, what we're coming from, where we are, it has created a tremendous mind shift in industry. We are not done. It's the beginning of it. But I think given the regulation context where we are now on the reporting and also EU taxonomy, what's going on in Japan and the US, you can clearly see that it's here to stay. It's not going to disappear. The question on environmental, definition of EU taxonomy from green point of view, and the big debate about the social angle, given the fact that you have a lot of Article 9, Article 8, Article 6, Article 8 and 9 are the most sort of ambitious. Article 9 is the most ambitious product. You will clearly have a shift in how these products are defined going forward when the social taxonomy has been agreed. And you can also see that many asset managers that have been selling the products under the Article 9 banner are withdrawing them from the market and also creating a more, I would say, a legal sort of a view on many of these documents for the fact that now, compared to a couple of years ago, they can be fined. They can be prosecuted. In many countries, offices have been raided by police for asset managers that apparently have been accused for greenwashing. So I don't think it's going to end. I think it's going to stay. And I also believe that the prospect of ESG really making a difference going forward will be in the space of showing clear and tangible results. Whatever these results are, we're talking about small incremental changes, but still we need to focus on giving people and giving our clients and also giving the societies we live in the concrete progress towards a transition to a more sustainable future. With these words, I wish that I would have been there, but now I'm not, and that you continue viewing the ESG in a light of what it is, which is a systemic sort of a change of the way how we approach investments. Thank you very much.
Thank you very much, Sasja, for this very inspiring outlook on ESG. Obviously, like other speakers in the last 2 days, you have laid out to us the challenges, and they are quite numerous, that the industry is facing and the world is facing with ESG investments. But as you also rightly said at the end, I think this is really a systemic shift in investments. Why? Because we cannot afford not to succeed. I think, as many speakers recalled us, we see the way nature tells us that this is really getting more and more urgent and action is needed. And this is where, as also was repeated by the finance minister, by the regulator and by other speakers, the finance industry comes in by mainstreaming the investments that flow into sustainable finance products. How do we get even more successful? Well, first we need to digest the regulation. We need to come to terms with all the new elements in it. Ladies and gentlemen, even if the current situation created by Russia's aggression in Ukraine, by the energy crunch that has been triggered through this, is really not helpful, to put it mildly, I think we cannot afford not to go down the route of ESG, even if expediency for the short term may make some go back to fossil energy. We all know that in the medium to long term, we will and we have to go even more and accelerate the path towards carbon neutrality. This was, I think, one of the main conclusions that I will draw. I will certainly not even attempt to summarize the nearly 7 hours worth of expert discussions and keynote speeches that we have had. You can re-watch them on the replay or share them with friends or colleagues that you think may be interested in this. The replay will be available as of later today or latest tomorrow morning. Ladies and gentlemen, this brings me also then to the end of this 5th edition of the Luxembourg Sustainable Finance Forum. It remains for me to thank, first of all, our dear moderator, Judith, for not only her loyalty with our program, but also for yet again leading us through it, not only with her positive vibe, but also her energy and her competence on the subject matter. I think that is very important for all of us. I also obviously want to thank all the speakers and the moderators for not only dedicating time to this, but also for sharing their knowledge. I think we've had a wealth of content given by these speakers and shared with us. So it would be I would be amiss if I didn't mention them. I also have to mention our sponsors. I'm very glad and very grateful for them to have so generously and numerously again supported this forum as in the past. Thank you very much. And then also let me thank the Financial Times, our media partner, for their collaboration with us, and the 3 moderators of the panel, the 3 journalists from the Financial Times, for their contribution. I would also like to thank my team at Luxembourg for Finance, and I look forward to having you back on our different programs. The next one will be on November 9th, a focus on skills, to discuss talent attraction, talent retention, what are the future skills that are needed in the financial industry. And then later in the year, on December 14th, we will attempt an outlook into the next year, 2023. Obviously, what we have learned in the past 2 editions is that that may be interesting, but probably also difficult to get right. But we will see. Thank you very much to all of you, and stay safe. Thank you.